Hey guys, welcome back to Invested. It's been a hot minute, so thank you for coming back. And looking at a lot of different questions now with the market landscape changing, and some people are ranting, some people are worried about asset classes and type of investment. So there was a question. It says, "What is your favorite asset class and why?" Getting tired of multifamily. I'm getting tired of how management intensive multifamily is. Hundreds of repairs each year, tenants moving in and out, yearly, constant unit turns, blah, 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 blah. I get your frustration. So instead of spending $5 million on 60 unit multifamily and having 60 different tenants and repairs, why not get a 12 tenant strip center, retail? Less tenants, they also tend to be professionals. You can also set up the leases where they take care of many, if not most of the repairs, which is triple net CAM. You can also decrease the property exit cap rate by working hard to get credit tenants. It also seems significantly easier to manage from a distance. You still need a good broker and PM, which is property manager in the area, but with multifamily, the whole return is dependent on the PM company to do their job. I get there is a higher risk factor due to each tenant making up a larger percentage of the tenant base, but leasing being 5x times multifamily leases make up for the 6 month of vacancy in between tenants. I'm a multifamily investor, but a retail broker. I work with landlords from all across the country that own retail in my market. They have only been to the property once. They're making bank from buying these real estate centers at 50% occupied, spending money, and CapEx, which is capital improvements, getting brokers like me to lease up the space and walking away with 2 to 3 times their investment, which is, I think, multiple. This is a grass is greener, as always greener situation, or am I on something? What's your favorite asset class and why? And I'll tell you, my favorite asset class is what makes me the most money is my favorite asset class. I've always been product agnostic, but I like this individual. I think he's ranting a little bit, but he makes really good points. But let me just kind of talk about it. All asset classes going to be challenging. So it can be multifamily, office, retail, hospitality, self-storage, industrial, single tenant net leases, light manufacturing, alternative as mobile homes or RV parks, all have issues. They have their strength and they have their weaknesses. So understanding these asset classes in general is good, but you got to understand that if you understand real estate, there's going to be elements that's going to cross over, that's going to be uniform throughout the investments in different asset classes. But in those asset classes, you're going to have nuances and different challenges, right? So as an example to this person posting is a lot of my good friends who are investing in multifamily and they've been very successful, just like you. But when I, bring up a retail asset in Arizona, it's going to be in Phoenix MSA. They're like, oh, this looks like a really good opportunity, Charles. What is your downtime? I mean, that if something goes vacant, how fast can I lease it up? I was like, look, usually my underwriting, there's an absorption period, downtime, usually 6 to 12 months. Sometimes certain areas, tertiary market, your downtime could be 24, 36 months. You know what happens? They freak out. And they're like, how do you do that? How do you live with that and take that much risk? Because if my rental goes out, within 30 to 40 days, I can lease it up. So why would I take the risk? And it seems like it's really a lot of work. These are kind of the sentiments throughout multiple asset classes. So I think this is a question is what makes the most money? And it's a very loaded question because all asset classes with right basis and good management, when you talk about PMs, if you have good property manager that adds value for you, all asset classes are going to do very well. My other videos, we kind of talked about spot to intrinsic value, which is today's value versus what value add you can do for future value. And those are all going to be predicated on how much top line revenue or how much growth, how much expense reduction you can do, but also macroeconomic, essentially, what the cap rate's going to be. If the interest rates kind of stay elevated, the cap rate's going to be elevated as well too. So you got to kind of understand that throughout the next 2, 3, 4 years, returns are going to be somewhat muted because you have high interest ratios. We have inflation, labor costs going up. When the labor cost goes up, your supplies goes up, right? For instance, if labor goes up in your toilet papers or your janitorial items or supplies, they're gonna go up as well too. So then you have to increase your top line revenue, and if you increase your NOI or it remains relatively the same, if you bought a property at 6 cap but the market turns at 8 cap, hey, can you make a lot of money? Not as much, right? That could be office, that could be retail, all different assets. So I think the question here is going to be is, within your subsector of the market or the asset classes, how can you identify and get the best asset that might have the best return? If you're going for high credit tenant, like, using retail as example, if it's going to be like Ulta Beauty, Publix, Kroger's, they're going to have the best credit, right? So they're going to have the best cap rate for you. But the work is already done. So what kind of additional value can you add to increase the value of the property outside of you just increasing the rents and hoping the interest rate comes down and market goes into expansion period? You could sell it for a lower cap rate, meaning that compressed cap rate than what you bought for. So then you have to be able to really think about value add strategy. So I think you mentioned in your post that some of these people coming into your market are buying up property at 50% occupancy and selling it in 2 to 3x. Well, that's the same philosophy. If you bought an apartment with 60 units, where 30 units were occupied, 30 units were unoccupied, you're going to buy it for cheaper. Why? Because commercial real estate, unlike single family home, are transacted based on your net operating income. So if you have 30 tenants, you have 30 vacant spaces because whatever the reasons are, maybe they're uninhabitable, maybe you're not going to be able to fix it, the value of the property is going to be lower, right? Then if you're going to go and lease it up, of course you're going to have a higher NOI. So even at the same cap rate, you're going to get a higher value. That could be 2 or 3x. So I think if you're being in multifamily, stay vigilant in the multifamily and kind of think out of the box. And the next purchase is trying to get the best basis as possible. There's a saying, and I heard from a broker, we were talking about some stuff, and he said something really funny, and I think everyone knows this, but I think they put it in a good way. So buyer and seller has a disconnect in the market, right? And we always kind of say, oh, it has to get bridged, or, sellers and buyers have to become more reasonable. So easy way to say is sellers want yesterday's prices and buyers want tomorrow's prices. Makes sense, right? You want it as cheap as possible. They want the highest value as possible. So then in those situations, you have to find ideal investments where the situation might be different for the seller. The seller might be forced to exit out of the property, or they're retiring, or it's motels or RV parks, and they operated 3-4 parks for such a long time. They did a great job, but they never put in technology. They never put in dynamic pricing. They never thought about amenities. They haven't thought about miscellaneous ancillary income based on the ADRs or per rentals. So that means they did a bad job. They just wouldn't be able to implement that. So it seems like you're a very savvy individual. You should be looking at that, how to add value, and finding these, older sellers who are retiring or they're kind of done with the business. And that will be the best entry point even for multifamily as well as other asset classes. And to kind of finalize everything up and to answer your final question, what is your favorite asset class? For me, today, it's going to be RV parks, boutique hotels, outdoor hospitality. I'm not talking about Hiltons or Marriotts that has 400 keys. I'm talking about 50 units, right? I'm looking at Northeast, the Northwest, the Sun Belts, trying to find that, diamond in the rough where they did a good job, but I'm going to be able to add additional value to increase the valuation of the property in my exit. So those are the things I'll be looking at. I am product agnostic and I'm indifferent to all asset classes. To me, everything is how do I get the best investment from a risk mitigation and get, the best return for the investors, myself, and the people who trust their money with me so I can get the better returns for them. So that's how I think every day. So when you start doing that, I don't think it's going to be an asset class, and he's going to think a little bit more holistically to see where your skill sets can be better used to extract the most value from your investment. Thank you for coming back and joining and listening to us. So if you like this content, if you found it helpful, please like, subscribe, and add comments. Thank you very much.